May 22 handed the market a strange mix. Stocks rose again, and the S&P 500 finished an eighth straight winning week. But at the same time, Kevin Warsh took over the Federal Reserve. Consumers looked worse than ever in sentiment data, and the rate cut story got less comfortable. The tape was green, but the setup underneath was hard. The closing numbers were solid. The S&P 500 rose 0.4% to 7,473.47. The Dow gained 0.6% to 50,579.70. The Nasdaq added 0.2%, and the Russell 2000 rose 0.9%. This is a market still willing to reward earnings and momentum, even as the macro backdrop gets tougher. The consumer side told a different story. The University of Michigan Sentiment Index fell to 44.8 in May, the lowest reading on record. Households are dealing with expensive gasoline, high prices, and the drag from the Iran war. The market is near records, while the average household says the economy feels worse. That split matters because buyers had reasons to stay. Ross Stores, Workday, and Zoom helped lift the market after better profit reports. Ross rose sharply after strong traffic and clean results. Companies can still beat expectations, and consumers haven't disappeared. They are just becoming more selective. The Fed officially changed hands. Kevin Warsh was sworn in as Fed chair on Friday. He inherits a market that wants rate relief, a president who wants easier money, and inflation pressure that hasn't gone away. His first job is building credibility. Christopher Waller made that job harder. He said the Fed should drop its easing bias and make clear that a rate cut is no more likely than a rate increase. He wasn't calling for an immediate hike, but the message was clear. The market cannot assume the next move is easier policy if inflation stays hot. Oil is why the rate story still has teeth. Prices stayed high because investors aren't convinced U.S.-Iran talks will quickly fix the Strait of Hormuz. If energy stays expensive, consumer expectations can keep drifting higher. That is exactly the kind of problem the Fed cannot ignore. Yields eased a little on Friday, with the 10-year around 4.56%, but that is still high enough to matter. Higher yields don't have to crash the market, but they raise the hurdle. Growth stocks need better earnings. Consumers face more expensive debt. The Fed has less room to comfort the tape. This is happening after investors already moved back into stocks. Fund manager exposure jumped in May, and the market has been climbing for weeks. Crowding doesn't mean the rally must end. It means the rally needs fewer mistakes. A new Fed chair, record low sentiment, and oil prices create more room for disappointment. Tech remains part of the support structure. NVIDIA and the AI leaders are still important, and the next read-throughs from server and chip names will matter. But today was about more than one stock. The question is whether earnings leadership can keep carrying the index if policy becomes less friendly. The takeaway isn't that the consumer is dead. Ross showed value retail can still work, but households are trading down, watching gas prices, and getting more pessimistic. That can coexist with a rising stock market for a while. It becomes a problem if companies stop beating expectations or if price pressure forces the Fed to stay tight. The watch list is direct. Watch the 10-year yield, oil headlines, and the next Fed communication under Warsh. Watch whether consumer sentiment weakness starts showing up in retail guidance beyond the value winners. And watch breadth. If indexes keep rising on fewer leaders, the split gets more fragile. The takeaway from May 22 is simple. The rally is still alive, but the policy cushion is thinner. Stocks can rise while households feel worse. Earnings can beat while inflation expectations worsen. Warsh begins with that contradiction on his desk. If the Fed cannot sound easier, the market has to stand on earnings instead of hope.